Welcome to my channel. I'm Dr. Romano. Have you ever wondered why Sam Bankman-Fried was so successful in the beginning and then afterwards the decline of that company? There's a lot of questions that I had that I wanted to have answered, and I've done a lot of research on exactly what happened. The reason why this is so important, because the first time in history that it's been so publicized that the typical investor overlooked their reasoning when they look for investments. And they did something very new, very out of the box. And I really liked how they did that. And so I want to share with you the real reason behind why Sam Bankman was so successful in the beginning. Before we continue the video, please remember to do thumbs up. It's right there. Just press the button and subscribe to my channel. That will really help me out. Thank you so much. As you know, I have a PhD in financial management and leadership. I've written over 1,000 pages of research on hedge fund selection and operational due diligence. I'm all about hedge funds in every way possible, and I have an MBA in finance and also in risk management insurance. So I have two specializations because I used to work for the investment bank in the chief financial office in risk management. So that's why I received an MBA in risk management. But because I worked in an industry called finance, I also wanted an MBA in that. With my experience and my education and my research background, I'm very much prepared to analyze this situation. I also ask a lot of questions to hedge fund managers, how they got started. When I was working for the investment bank, basically everyone on the trading floor that was approachable, that wasn't nasty, I was speaking to and I was asking questions. I got out of them how they got their job, where they went to school, what they studied. I just love asking questions. The question is, when Sam Bankman-Fried got started, his biggest push was his parents. Because they were attorneys, and when you want to start a new business, so to speak, in his caliber, you need the PPM documents and all the legal documents and filings necessary. If his parents weren't attorneys, he would have had to dish out in excess of $50,000, the minimum. And when you want to update stuff, you also have to spend money. So that was his first push in his career, which he had free legal advice. This is very important. So when you want to start a funds of funds or a hedge fund, you need money to start. And you're not going to make money in the beginning because you have other expenses that you have to pay for. Having someone behind you that has a lot of money or free legal advice is so important. Next, he had a number of people that he must have been connected with that had money. And one of his business partners did have money. So that was the push in his career. If you didn't have that push and you were starting, let's say, a hedge fund or a funds of funds, then that's a block that you have. Because you may have the PPM documents and all the legal advice behind you, but you need someone credible to be on your team or behind you, or someone that's promoting you. Now, typical investors in the hedge fund community I'm talking about, not that Sam Bankman-Fried was all a hedge fund, he did open one up in the cryptocurrency market, but the equity market is very different because you have people in the industry that allocate capital to new hedge fund managers. And some of the questions that they ask, one, they look at experience, and this is a major factor in them putting up the capital in your fund and becoming a client. In Sam Bankman's history, what we know is that he only had approximately 2 years trading experience. Now, that is very probable because in order for a hedge fund manager or a trader to successfully trade over a long period of time, they have to trade through one market cycle. And this is because you have to analyze their returns on all the different market conditions. For example, maybe their strategy is not going to work for a market that has high volatility. Maybe their strategy will actually work for a market that's trading sideways. And these are all questions that the hedge fund investor has to analyze. It's not just based on experience, so to speak. It's more based on the markets that he was trading in and when. So, and this is very important because you could do all the simulations you want on his returns, his hypothetical returns at that time. Unfortunately, a computer simulation will not show you all the different scenarios. And you can't do this in a computer because you're forgetting the mind behind the trader. And that's also affected. And doing these simulations like I did in my PhD research, I looked at a lot of different information, whether the size of a fund has watered down returns, exactly what point that actually happens. And because of that, it's very important to know that, because when you create a funds of funds portfolio, you have to know how to balance your portfolio of hedge funds based on the future markets, not just on all the different markets. Your returns will be watered down. In Sam Bankman-Fried, investors were looking at his experience. One, they weren't even looking at his experience because he only had 2 years experience, that's number one. So that was a very interesting how he got past that. The next thing which really, really affected me, and I really wanted to analyze, was how did he raise 30 or 40 billion dollars within 2 years? Well, he had people that he knew or that he was connected to that were able to refer him to, let's say, that billionaire who has billions of dollars or something like that, that could invest $1 billion. And because, let's say, a hedge fund manager said, yeah, Sam is a really good fit, he'll do very well, well, that's a reason why an investor would actually put up capital, because they're taking your word. You know, I tried to analyze the fact that, yes, he was paying someone to promote him. That's what some people actually do. You could pay companies to promote you. But in his case, he took somebody famous and he was paying them to promote his fund and his idea to people. Sometimes when you are about to go out to the public to start your hedge fund, maybe you shouldn't be going to those family offices or those investment banks or those endowments or the people in the industry. Because the fact is that all those people have a certain criteria that they follow. And when they follow that, you may not be in that criteria. One of the questions is they ask you, what's your education? Where did you go to school? What did you study? And unfortunately, all of that is irrelevant, because one of the most successful traders of all times, Richard Dennis, he didn't have a college degree. He was a sweeper on the commodity stock exchange in the 70s. He got that job through his father, who was also a sweeper. Even the sweepers had to know someone to get those jobs because they were so valuable. Because you were meeting very well-to-do people that have a lot of connections back then. It's not like that now on the trading floor. The trading floor, those traders really don't make a lot of money. But back then, it was the old school. They made a lot of money. So again, he was lucky to be on that, but because he had the mind of a trader, that pattern recognition, Richard Dennis did really well. And there was many other traders that didn't have a college degree, because you have to remember, college was pushed in our face in the mid-1990s. That's when it really grew, that everyone should go to college, and this mentality. Before the mid-1990s, people went and studied trades and they opened their own business. But to get back to the point is, yeah, he had someone behind him, and possibly he was going out to people who weren't in the industry. Because those people that aren't in this industry, when they read the PPM documents and the fact sheet and whatever those documents are that he used, 100 pages, 200 pages is a lot for an investor to read. But when he spoke about what he wanted to do, and you knew about all the people that were behind him. Not that he had a good team because he did it. He was hiring his 20-year-old friends. So this is another thing, is that investors look to see who's on your team. So when you create a hedge fund, it's ideally to put a big team behind your back with credible people. And that's what investors are looking for. Who's on your team, who you connected to, that's credible. Now, this is something that I want to share with you. The reason why investors are looking to see who's on your team, yes, they're looking to see if you have credibility, that you will succeed, but in psychology, in organizational psychology, we learn something. In order to do a deal at the deal table, they're doing a subconscious split-second yes or no in their mind. They already have it in their mind even before they sit down. But when they meet you, in their mind, they're putting whether or not they could trust you or not. And it's a split second that actually happens. Good salespeople, they have charisma for trust. And so people will trust them, and that's why they become successful. Because you could have someone that doesn't have charisma and do all the legwork, to work 24 hours a day, whatever it is, 7 days a week, but they won't become successful. It's only those that have charisma and that ability to create trust in the client. So somehow he had that, because if you look at his team, again, he bypassed the traditional who's on your team, as an investor would ask. He didn't have a team. His team was his best friends in college. They were in their early 20s. Again, he put his girlfriend as a trader. She had no trading experience. And he put other people that he knew. This is really, really disturbing, because he'll raise $40 billion in 2 years. They would have never selected him if they really looked at on who's his team. Next, so as I mentioned, the legal advice that he had, that's a free game. His team, it wasn't anything special. His experience wasn't anything special. The next thing which really disturbs me is that even a hedge fund manager, Anthony Scaramucci, had mentioned in an interview, and the interviewer said, well, why did you invest in him? Meaning, why did you invest in Sam Bankman-Fried? Anthony turned around and said, I liked his personality and I liked his idea. Okay, so right there, Anthony Scaramucci, he's an entrepreneur apparently, because that's how entrepreneurs, real entrepreneurs, think. He overlooked his experience, he overlooked his team, and he overlooked really a lot of other things. Now that you have Anthony Scaramucci putting up money, I don't know how much he put up. I remember the amount, it was a lot of money, but it doesn't equal to 40 billion. So somehow he found many other people like Anthony Scaramucci, and maybe it is possible that Sam Bankman-Fried knew which people to look for, the personality. Not all people are gonna trust you as a person, as a hedge fund manager. And so to get past the team, who's on your team, to get past what's your experience, to get past where you worked, in other words, he worked at just a 2-year period. Now the fact is that traders don't just start off as traders and they work 2 years. It doesn't happen like that. You become an assistant trader. You either get recruited because you know someone at that company, or you get recruited because you're from an Ivy League school. Investment banks will only hire, for the majority, someone from an Ivy League school to be a trader or to work in the chief financial office. And I know this because I have experience in that office, and that's how it was. You had to have a PhD to become a director. You had to go to an Ivy League school to become an analyst and to get recruited. Now, of course, there's people at the company that knew someone at that company. And that's why you got hired. That's how I got hired, because it's very difficult to get into the chief financial office for a big investment bank. And the company that I worked for, it wasn't Bear Stearns. It was the top 2 investment banks. I'm not going to say who it was. Again, Sam Bankman-Fried, what real experience he had? He didn't really have any experience, because he would have had 4 years experience as opposed to 2 years, because you work as an assistant trader for about 2 years, and then if you're lucky, you get promoted to become a trader. Somehow somebody promoted him. Maybe it was luck. You're at the right place at the right time. Someone gets fired, or several people get fired, and you become a trader. It does happen. Now, what's really important, that the investors, in his case, if they weren't going to look at his experience, because he didn't have any really, they weren't going to look at his team, because he didn't have a team. They were his friends from college, they were his age, and he was in his mid-20s, early 20s. Then you have to ask, well, what were they looking for? Is it possible that he had charisma when he spoke and a dominant quality? I've analyzed his personality, and to be quite honest, I didn't see that. I didn't see a dominant trait, and I didn't see charisma when he spoke. I seen someone who had very, very bad communication skills. His pronunciation, his sentencing, everything, it didn't make sense. Yes, I think investors, they looked at him as a nerd, and that maybe they realized that some nerds, they don't communicate so well. But maybe he wasn't a nerd, but he certainly knew what questions that investors would ask, and he knew those questions, how to answer them. So he was prepped by many people, or someone that was in the industry, which is very important to know, because when you become a hedge fund manager, meaning you're establishing your LLCs and your LP, and you have your PPM documents and your fact sheet and all those legal documents done by an attorney, the next stage is to actually promote your concept, your fund. And you may not even have any money in the fund when it starts, and that's okay. I want all of you to realize that something recently has happened, that the traditional method, I have PhD research on the traditional method, and the reason why I did my research, because I knew what I wanted to do when I got older, and that is that people are starting to think outside of the box. And this is very important, because you could look at 100 hedge funds and do your legwork on who's on their team. They list it on their website. You could also do the legwork where they went to college. Sometimes they do list it on their website, or you could just ask them. And what I've noticed is not everyone went to an Ivy League school. Not everyone has a very good team. A lot of people put people on their team. The probability is, let's look at it this way. If you are a trader and you're trading, right, why would you need a risk manager? Okay? So the reason why we have that ideology is because the investment banks have trading groups, and they have the head trader. The head trader is responsible for each trader, whether they're teaching them the strategy, or they're improving it, or they're focusing on that strategy. It's actually not very hard to trade. You just have to be able to think very quickly. The most successful ones have pattern recognition. But we're talking about investment bank traders. They're not hedge fund traders. It's very different. An investment bank trader is taught the strategy. Most of the time, they don't even have experience trading because they got recruited. Whereas the hedge fund manager is very different. That person has trading experience of several years, 4 to 5 years, before they really start to become someone. And because they took that responsibility into their own hands, they have the power and the control to change their strategy, to improve it. And part of being very successful at trading is to manage your losses. In other words, managing your losing trades. So if a trader can't trade and do that, they'll never be successful and never raise capital. I don't care if you're doing 5%, 7% a year steady for the equities market, so to speak. Investors may misunderstand that, thinking that it's a safe bet because they're always producing a low return, and thinking that that's not risky, but that's not true. It has nothing to do with how high your returns are. It has to do with the trader themselves on how they manage their losing trades, and that's managing risk. Again, the ideology of having a team with a risk manager and all that on your website for a hedge fund, I believe that's a waste of time, and also that's phony. They're just feeding into what investors would look for. And again, the people in the industry, just because that's what it is and they're doing in the industry and what they've been taught, it doesn't mean that's proper or that's beneficial or that will improve the investment selection process. Because I have decided in my PhD research, I decided to disprove the traditional method. And that's the traditional method on managing risk. And what I found is that all those risk measures are out of date in today's market. And the methodology behind it. And the reason that I took this and I created this PhD is because the stock market collapsed in 2008. And I realized that the investment bank and all those methodologies that they're using are out of date. They don't foresee the risks. So again, for you investors out there, you should not be looking at who's on somebody's team. Because apparently, Sam Bankman-Fried raised $40 billion and they didn't care on who's his team, who was on his team. Does that make sense? So the people in the industry have to change, and you have to realize, yes, Sam Bankman, he didn't have the experience to get through a collapsing market, but you should have been asking yourself, what's his experience on those what did his fund do, or the simulation of what the fund did. In the case of a funds of funds, it's much more easier to figure out how that funds of funds will do, because you could look back 7 years, because they have the returns the previous years from each of the hedge funds. So they have their average, the returns and everything. Those funds are called hypothetical returns. And those hypothetical returns are very, very important. It's not asking someone who's on that person's team as a funds of funds manager or what's their experience. You have to ask, what did they do to improve the investment selection process? And that's very important, because that outpasses experience, okay? Because experience at an investment bank or at a funds of funds, so to speak, or a hedge fund, you are required to do what the company wants. You cannot just change the investment approach. You are following what the company leaders want. Secondly, you're also following what the industry wants, okay? Because remember, people hire either their friends or the people that they know and they trust. So again, just because they hire their best friend, does their friend really know what they're doing? The question is no. They're just winging it, basically. And they're just following what everyone wants in the industry. And also another issue that is very important is that employees, when they're an employee, they try to stay under the radar. And what I mean by this is that they try not to shine, because the dominant one in the group will get rid of them. And they know this because they're very smart. And the dominant one will do everything that they can to remove their competition. The dominant person in the group is only good at one thing, and that's removing their competition. So either the person gets fired because they said something that's not true about that person, or the person quits because they're getting an ulcer to deal with this person. Again, so you have to be very careful on really looking at, well, who's on his team, who's on their team, etc. Because it's better to go with a smaller hedge fund manager than those big companies, those big hedge funds. So to get back to the fact that the investors, when they analyze Sam Bankman-Fried's company, well, apparently everything that you normally do in the industry, they didn't do when it came to him. And this is what I found out. And this didn't lead to the downfall of his company. I will tell you the downfall of his company. The downfall of his company is that if you're a trader, an investor needs to look at what did you do when the markets were collapsing? Did you work in a collapsing market? And they analyze those returns during that before and after period. This is very important because apparently they didn't care about his experience and they didn't care about his education because he didn't go to Ivy League school. Massachusetts Technology School is not Ivy League. Yeah, he may have gotten top grades, let's say, but people who get good grades are just good test takers. They have a short-term memory that's expansive. An entrepreneur, such as Anthony Scaramucci, is someone who has a long-term memory and that's highly visual, and he probably has pattern recognition since he was a trader. Again, as an investor, you need to know what questions you should ask because you could very well ask the wrong questions, and based on that outcome can be total devastation. So again, I hope I provided a great deal of information in this video to analyze and to talk about. Thank you so much for watching my video. Please remember to subscribe to my channel and do thumbs up. It's right there. It doesn't hurt to help, but that's going to really help my channel out. Thank you so much.